Welcome to this Sustainalytics webinar on our new thematic report entitled Water Scarcity, Will Investors Be Left High and Dry? My name is Henrik Gartz. I'm the Global Head of Sustainalytics Thematic Research Team, and I'm welcoming you to today's webinar in my role as a co-author of the study and as your moderator for this session. We are delighted that so many of you can join us today, and I would like to extend a special note of welcome to those of you that are joining us for the first time. And for those of you who are unfamiliar with who we are and what we do, Sustainalytics is a responsible investment research firm providing detailed ratings and analyses on the environmental, social and governance performance of companies and countries, and we do that mainly for institutional investors who integrate our insights into their investment decision-making processes. One of the many things that Sustainalytics does is to produce top-down research, including sector reports, periodical pieces such as our 10-4 series or our ESG spotlights, and larger thematic notes such as the one we are looking at today. I'm joined today by my colleague Doug Morrow, who is Associate Director of Thematic Research and is the main author of this report. And in a moment we'll present the key findings and takeaways of the report to you. Also on the panel I welcome my colleagues Joshua Sakai and Kate Marshall, who will add their sector-specific views to the top-down analysis Doug will be focusing on. This presentation will take approximately 60 minutes and will be interrupted and concluded by Q&A sessions to allow us to finish the webinar by 5 p.m. Central European Time and 11 a.m. Eastern Standard Time. Before we begin, I would like to highlight some housekeeping issues for you. You are currently all muted and will remain so for the duration of the webinar in order to minimize any noise disturbance. In this instance, we invite you to send any questions you have about the report or webinar to us through the interactive box you see at the bottom of the screen, here highlighted with the number 1. Incidentally, if you have any audio problems during the course of the webinar, you can also inform us of these through this interactive box. Also, if you would like to minimize this interactive panel, you can quite simply do so by clicking on the arrow at the top of the panel indicated by the number 2. Finally, this webinar is being recorded and a copy of this recording will be sent to all participants in the coming days. Now turning to the report itself, we take a quick look at the agenda first. We will start by taking a look at the water scarcity issue from a top-down or, if you like, macro perspective. We will then move on to 2 sector-specific views before we will wrap up with an investment risk and opportunity perspective and a couple of conclusions. The presentation will be followed by an extensive Q&A session. Before I hand over to Doug, let me briefly introduce the topic by giving credit to the recently published World Bank report on climate and water. In this report, the World Bank reckons, among other things, that water availability in cities could be reduced by as much as 2/3 by 2050 compared to 2015 levels, and that growth rates in some regions may decline by as much as 6% of GDP by 2050 as a result of water-related losses in agriculture, health and property, sending them into sustained negative growth. Furthermore, it is pointed out that changes in water availability and variability can induce migration, which is surely an inconvenient truth for the developed world as well, probably in particular for EU officials currently struggling with political ramifications of the refugee issue in Europe. In conclusion, the World Bank calls for advances in water management policies, not the least because it considers this as a necessary condition to achieve the UN Sustainable Development Goals, of which nearly all are linked to each other via the common currency, water. 3 overarching policy priorities are defined in the report that can help lead countries down the road to a water-secure and climate-resilient economy. Firstly, the optimization of water use, which means A, increasing water efficiency, and B, optimizing the allocation of scarce water resources. This could be achieved through planning and regulation or using market signals through instruments such as prices and permits. In this context, the World Bank does not hide that it believes that free water is a key source of the problem and that establishing a price for water could reduce the costs for the poor and the environment considerably. The second priority in the eyes of the World Bank should be to expand water supply and availability where appropriate. This includes investments in storage infrastructure such as dams that makes water available when it is needed, water recycling and reuse, and where viable also desalination. And last but not least, the third priority should lie in the reduction of the impact of extremes, variability and uncertainty in water supply, or you could also say in the increase of our economy's resilience vis-à-vis water risks. This includes better urban planning, risk management and citizen engagement to reduce the exposure of cities to flood risk. Large capital investments such as seawalls and dams may also be necessary to protect coastal cities from storm surges and floods. As you've seen in today's agenda, the policy priorities defined by the World Bank are also reflected in how we analyze water risks and opportunities from a business or company perspective. With this, I'm going to hand over to Doug now, who will present the first part of our report to you now. So Doug, over to you.
Thanks very much, Hendrik. As Hendrik mentioned, my name is Doug Morrow. I'm the Associate Director of Thematic Research here in Toronto. And together with my co-authors, Madir Olivar and Hendrik Gars, I was one of the authors of this water scarcity report. And once again, thank you very much for joining today's call. So I just wanted to follow up on one of Hendrik's points before we get into the key findings. And that's really to say that as many of you probably know, water really is becoming a much more important financial investment and ESG issue across the board. And our report comes on the heels of a variety of different studies that have been published in the last couple of months that are serving to raise awareness about the water problem. Of course, we have the World Bank report that Hendrik mentioned, which essentially argues we're looking at a severe hit to economic growth as a result of scarcity. There was a report published in February by the World Energy Council, which essentially argued that a massive scale-up in infrastructure spending will be required in the future. And then, of course, as we all know, water was recognized by the World Economic Forum back in January as one of the single most significant risks facing the global economy. And they ranked it ahead of things like cyber attacks, interstate conflict, and even the global unemployment problem. You know, so clearly this is becoming a major issue. And I think also for investors, as we'll get into later, we're seeing much more tangible evidence about how water scarcity can impact firm production. So that link is also increasingly being made. So just to reiterate that our report is coming on the heels of a variety of different studies on this topic. So I think it's an easy case to make that investor awareness about this issue is increasing. Certainly the CDP water program, for instance, has grown quite substantially. But we would argue that most investors are still not thinking or indeed executing strategically on this issue, on the issue of water. There are two main barriers. Again, we'll touch on this later, but the first is the disclosure problem. So right now, only about 1,100 publicly traded corporations are disclosing their total water use, which prevents some challenges from an investment context. And secondly, as Hendrik mentioned, there's a lack of a clear pricing signal, which we get into later. But nevertheless, despite these barriers, we do anticipate a significant ramp up in investor action in the years ahead. So in terms of what we did in our study, it's essentially organized into two parts. The first part looks at the problem. The second part looks at what investors can do about the problem. So this slide helps to illustrate the nature of the issue. Our approach for tackling the water problem, water scarcity, was to simply use a supply and demand perspective. This really borrows on a lot of the good work done by the 2030 Water Resources Group. So first of all, at a macro level, again, as I'm sure most of you are probably aware, when we think about water use by economic activity, about 69% of global water use goes to the agriculture sector. Industry is responsible for 18%, and municipal use about 13%. So the main message there is really that the bulk of global water use is intimately tied to the cultivation of crops and the global food production system. So when we think about drivers of water demand, I don't think there are any surprises. Water demand is linked to population growth. It's linked to general economic expansion, also urbanization. Perhaps the one surprising driver, though, that some people aren't aware of is the growing trend towards increased meat consumption. So we know that the more meat in the system means the more downstream impacts on water, because, to put it frankly, producing meat takes a surprisingly large amount of water. The OECD is forecasting that across the board, we're looking at a 4% increase per person in meat consumption over the next 10 years. So given these broad-based drivers of demand, I don't think it's any surprise that to learn that water demand is actually growing at twice the rate of population. And as you can see here, the 2030 Water Resources Group is forecasting that total global water demand is expected to reach 6,900 billion cubic meters by 2030. Of course, I think like any forecast, we need to be skeptical and do view it with a grain of salt, because there are assumptions that flow into that forecast. But I think the main message is really that water demand is beginning to significantly outstrip supply. And then when we do talk about supply, again, these are numbers that will probably resonate with many of you on the call. It's simply that there is a supply constraint issue. So only 2.5% of all water on Earth is fresh water. That's a well-known statistic. But one of the interesting things I learned in writing this paper is that only a relatively small proportion of that 2.5% is easily accessible. In other words, not tied up in the polar ice caps or glaciers that are really hard to reach. And then on top of that constraint, only a proportion of that can be exploited sustainably. In other words, not replenishing unreplenishable aquifers. And then to layer yet another constraint, there's the issue of infrastructure. So right now we're dealing with a situation where we simply cannot get access to all of the water that meets these constraints due to a lack of water infrastructure. So again, to sum all this up, the main takeaway here is that only a tiny, tiny fraction of all the water on Earth right now is supporting the global food production system, as well as economic growth through industry and households. So just one quick point before we touch on the water use by industry is the climate change angle. So thanks. Yeah, we should just stick here for one sec. So I think the climate change angle, I mean, to us that obviously resonates, quite nicely. But in a lot of reports that we came across in writing this study, it's not properly factored into models. So, and that's because of the challenges in so doing, of course. But the main message with climate change is it's not going to make the water situation any easier. The two main risks, and Hendrik touched on this in his intro, is that it's going to reduce the theoretical supply of fresh water by melting things like the polar ice caps. But I think even more importantly, as sea levels rise, they could very well start to threaten freshwater resources that are located in coastal regions. So to summarize, as I said earlier, we're dealing with a situation where demand is starting to significantly outstrip supply, which is where we get the idea of the water gap. Now, I think like any economist would say, there are ways to close a gap between between demand and supply. One way is to improve efficiency, and the second way would be to simply boost supply, again, by investing more in water infrastructure. The main barrier, though, to improving how corporates and households use water is the lack of a clear pricing signal, and we'll touch on that a little bit later. One of the stats we cite in the report is that the amount of crop per drop, so essentially the amount of agriculture output per unit of water, has only increased by a meager 1% per year over the last couple decades. So yeah, taken together, what this means is we foresee a fundamental rethink about how water resources are managed, and ultimately this will have implications for corporates and investors. So this slide here, I'm not going to get into the details, but I think investors and asset owners really need to understand how water is used by companies in their portfolios. And this chart, as simple as it seems, was actually not easy to put together. I found a real dearth of good literature on how water is used in the economy across sectors. So again, I'm not going to go into the details here, but I do invite anyone who's interested to have a look at this table. And it sort of simply shows how water is used. It's an integral ingredient in a surprising number of manufacturing processes, production processes, resource recovery, etc. So the idea of scarcity, it's very much a local problem. That's not to say that the ramifications of water scarcity won't eventually be felt globally, but one of the clear findings from our research is that even within countries, it's very much a local problem. So you can see here there are lots of good resources on this issue. For example, the WRI, as some of you probably know, has excellent research in this area. We chose this particular map for a few different reasons. But you can see here the hotspots are really the usual suspects, the Yangtze and Yellow River basins in China, India, the Murray-Darling Basin in Australia, that's been known for a long time, the Colorado River Basin in the US. And one of the things I'd flag here is that many of these countries, it's somewhat surprising, they also show up on lists of the countries with the most water resources. So this really underscores how scarcity is a local problem. China, for instance, has a surprising amount of fresh water. The US, surprising amounts of fresh water. Brazil, one of the world's water giants, yet all three of these countries within their borders are facing pockets of scarcity. And I think the final message I'll flag here is simply that if you cross-reference countries that are already experiencing water scarcity with forecasted demand and where that's going to play out, unfortunately they line up to a significant degree. So for instance, China, much of the growth that the 2030 Water Resources Group is forecasting over the next 20 years is going to come in China, especially the industrial sector. It's also going to come in the agricultural sector in India. And as you can see in this map, these countries are already in certain pockets experiencing scarcity. So with that, I'll pass it back to Kate.
Thanks, Doug.
Yeah, thanks, Doug. Before we will hand over to Kate, we'll take a look at water issues in the mining sector. I would like to ask you one question that has been submitted to us during your presentation. So, Doug, you talked about how the lack of clear pricing signal is discouraging efficient water use. Can you please elaborate on that issue? Are we headed towards the privatization of water?
In my personal opinion, I think the answer is yes. I don't, having looked at this issue pretty carefully in the writing of this report and in another research I've done, I honestly don't see how we can tackle this problem without, really meaningfully exploring market-based mechanisms. But again, just to be clear, water trading is alive and well. It exists in most prominently in Australia, the US. They've experimented with water trading in Chile. And I don't want to get into the details, but essentially it's similar to the way a cap and trade system is set up. I think the main challenge, though, is that there's tremendous resistance, and with good reason, in my opinion, towards putting a market price on water, because water has been recognized as a human right. So the United Nations recognizes water, access to clean water, fresh water, as a human right, and it's also seen as a public good. So this will be to be totally frank, I think it's going to be a massive headache for policymakers. But having said that, I really don't see how we can avoid exploring more privatization of water in the future.
Okay, thanks again, Doug. I guess we come back to that during the Q&A session at the end. So we are now moving to the next part of the presentation, taking a deeper dive into the water challenges in the mining sector. So Kate, could you please share your insights with us?
Yeah, thanks Hendrik, and thanks Doug. So to take a closer look at the mining sector, I'm going to discuss how mining companies use water, what risks they face associated with water scarcity, and some of the best practices to mitigate those risks. Firstly, mining companies use water in mineral processing, dust suppression, and to heat and cool machinery. During mineral processing, water is mixed with ore to form a slurry that is more easily processed. And water is also used as a solvent for chemical reagents that are used to separate target metals such as gold from ore. After target metals are separated, leftover slurry becomes mineral waste known as tailings. This is then stored in massive ponds or dams. The amount of water used in each of these steps depends on the nature of a certain operation. For example, if it's an open pit mine in an arid space, there's going to be more dust to suppress. Ore grade can also affect the amount of water required at a specific operation. Ore grade refers to the concentration of target metals in ore. So if there's a low ore grade, which is often the case in the precious metals sector, more ore is processed in order to access an equivalent amount of target metal. Geography also plays a big role in a company's exposure to water risks, and unfortunately, a lot of the world's most popular or friendly mining jurisdictions face high levels of water scarcity, especially Peru, Chile, Australia, and parts of Africa and Mexico. Where water scarcity is a pressing issue, mining companies face increased regulatory and stakeholder scrutiny. Perceptions of a company's water use, regardless of its actual consumption rates, can be a leading cause of community conflict at mine sites, especially in water-scarce regions. For example, one of the chief concerns with Newmont's $5 billion Conga project in Peru was water availability. And as many of you may know, the company just announced that it is walking away from this project due to community opposition over water resources. And that's after 6 years of trying to develop it. Similarly, Southern Copper's $1.4 billion Tia Maria project, also in Peru, has been stalled for over 5 years due to community opposition, also over water resources. Aside from reputational risks associated with water use, there are also operational and financial risks. Lack of water can force companies to cut production or to build costly workarounds such as desalination plants, which are both costly to build and costly to operate. They're highly energy intensive as well. Desalination can cost between $2 to $5 per cubic meter of water, and an average mine uses about 15 to 20 million cubic meters of water a year. So you could be looking at tens of millions of dollars to run the plant, let alone construction costs, which also range from 50 to 100 million US. In an industry with low or at least varied margins due to commodity cycles, this is a significant amount of money to be spending at the site level. As it is, water infrastructure costs already make up about 10% of a mine's operating costs, and desalination is said to triple those costs. Another way operational risk shows up is that companies are finding it increasingly difficult to obtain permits in jurisdictions facing water scarcity. Chile especially is pushing back on water permits, allotting companies only half of the water allotments they ask for in project proposals. Last year, Chile even tabled a law that would make desalination mandatory for any mine using 150 liters per second or more, which is most mines. To mitigate these operational and financial risks, companies are exploring water efficiency measures, ways to recycle more water, and other innovations. One of these is desalination, which is an increasingly common workaround, but it is costly and highly energy intensive. So to skirt some of the cost issues associated with desalination, Goldcorp and Teck took an interesting approach by merging two assets located 40 kilometers apart in Chile's Atacama region to create a mega project called Project Corridor. One of the projects involved in this, Goldcorp's El Morro project, had issues obtaining its environmental approvals for the project and was forced to redesign to include a desalination plant. But now under this joint venture, Teck and Goldcorp will share both the cost and the benefits of the plant. The sites will also share a tailings dam facility. And tailings management is another area where innovation can help reduce water consumption through increased water recycling. By removing more water from tailings and treating and recycling that water, mines can decrease their overall water consumption. This dewatering forms thickened tailings, which also reduce the risk of tailings spills. Thickened tailings aren't devoid of all risks, as they can still lead to contamination and seepage, but they do reduce the risk of catastrophic spills and ultimately mean that less water is being held up in mineral waste. These are just a couple of examples of what companies are doing to mitigate the risks associated with water scarcity, but I can revisit these examples and more in the Q&A. For now, I'll pause and pass it over to my colleague Josh, who's going to talk about water risks in the food sector.
Thanks, Kate. Now, when thinking about water use in the food sector, particularly in packaged foods and meats companies, you can think of these companies as having both direct and indirect water use, and therefore direct and indirect exposure to water risks. When I'm talking about direct exposure, I'm focusing mainly on the types on how companies are using water in the manufacture of food products. And examples of this would include water as an ingredient, water used for cleaning raw materials, and water used for sanitizing plant equipment as examples. Indirect exposure to water risks are largely driven by the need for vast quantities of fresh water for agricultural production, which then provides the raw materials that are the key ingredients in companies' products. And when looking at water use and the associated risks, it's also important to consider the types of products a company's portfolio is made up of. So if a company's products contain relatively higher amounts of water as an ingredient, or if the company is depending on relatively more water-intensive agricultural inputs, exposure to risk could be higher. And of course, geography is also playing an important role here, and companies that are operating in or sourcing from water-scarce regions could be facing higher risks. So keeping in mind that agriculture and in general the food value chain is incredibly water-intensive, Doug cited the stats about water, about 70% of fresh water use going into agricultural production. It also flows from that significant changes in water availability or quality can create concerns for companies that are operating in the space. And I've got a few of these types of risks listed here, and some of these risks, of course, are related to one another. And I'll go through some of these in detail. And first, we'll talk about shortages quickly. Of course, shortages arise when there's an imbalance between the amount of water that is being demanded for use and then the availability of that water. And in rebalancing that imbalance, you can see a number of scenarios play out. And this could include the reallocation of permits for water use, the rationing of water, or general increases in the price of water, all of which could have differing ramifications for food companies. Community opposition is another area where we see risks for companies, and this is closely related to brand damage as well. But in areas of high water stress in particular, where you have companies operating and competing with local communities for water use, especially when those local communities are having difficulty in accessing enough water to meet their needs for sanitation, hydration, agriculture, you could see opposition springing up and in some cases this has led to the closure of facilities, and we saw this happen with Coca-Cola in India, for example. And finally, we can see the possibility of increased procurement costs on the horizon as the availability of water or extreme weather events related to water, such as ongoing drought, could impact yields and harvests. And if this is happening on a large enough scale, affect global commodity prices, which will make it more expensive for companies to source the agricultural raw materials that they rely on. So with these risks in mind, we are seeing companies employ a number of strategies to address these risks. And one of the most common things that we see are just efforts to use less water, and this largely happens through water efficiency or absolute reduction targets for water use. Another type of activity that we're seeing increasingly frequently is water footprinting and risk mapping. Of course, there's also companies that work with suppliers to increase their resiliency to water issues and to provide capacity building for using water more efficiently. And on the leading edge of some of these types of activities that we're seeing is watershed management. And I'll give a little bit more detail to two of these examples, starting with Nestle's water risk mapping exercises. Nestle has a tool called the Combined Water Stress Index that it uses to map water stress levels at the at the facility level, so the water stress that each of its facilities are exposed to. And with this rating, it works to identify the current and future risks associated with water use for those facilities, and then it uses this to help prioritize investment decisions. Now, of course, Nestle has been one of those companies that's really had a lot said about it with regards to water use in water-scarce regions, particularly in California. But you see the companies using tools like this to help prioritize investments in those types of regions. The next example that I'll get into is General Mills. And General Mills has announced a commitment to champion water stewardship plans by 2025 for its material at-risk watersheds. And it's doing this in a number of phases. It's already advanced with regards to this goal to the point of having mapped its most material at-risk watersheds and now identifying stakeholders to work with down the line to start stabilizing and ultimately rehabilitating these watersheds. And with that, I'll conclude my portion of the presentation and pass it back along to Doug to talk about some strategies.
Thank you very much, Josh. So up until now, we've essentially focused on the first part of our report, which is looking at the nature of the water scarcity problem, complemented by some deep dives into the mining and food sectors. In the second part of our report, as I mentioned earlier, we took a different angle and said, okay, so what can investors do, given this problem? And our approach was to come up with a relatively parsimonious strategy. The advantage of keeping things simple is that it's just much easier for investors to kickstart how they might think about and indeed act on this problem. So the first pillar, so to say, in our framework was simply to assess exposure. So water risk for investors is primarily a function of two things. So one is the extent to which they own portfolio companies that are classified or indeed operate in water-intensive industries. And the second, and I think frankly more important driver, is the specific location of those companies' assets and operating facilities. So you can see here in the bottom left of the slide, these are the 8 industries that we believe are most exposed to gross water risk, the most water-intensive industries. And you can see one of the metrics that investors can use to get a high-level understanding of how companies are positioned is using an intensity metric. This graph shows total water consumption in cubic meters divided by revenue. Now, revenue is not the ideal metric to use when you're taking a really close look within industries. Ideally, you want to use something that's more closely tied to production, such as tons of ore processed for mining companies, or maybe amount of grain or food produced for food companies, something that's more indicative of actual production. But the advantage of revenue is that it provides a relatively simple metric that you can use across the economy. So you can see some of the deltas here that we're looking at within given industrial buckets. In particular, in the precious metals sector, if you look at the discrepancy between Barrick and Goldcorp, it's actually quite significant. It varies by a factor of 5. Of course, not to be totally clear, not all this is a result of differences in management's approach to water. Different ore bodies, for example, as Kate mentioned, require different amounts of water and things like that. But it does signal that you can use this analysis to identify companies that might not be keeping up with best practice in terms of water management. And I think, again, one of the drivers here for investors is simply, as I touched on earlier, the growing evidence that water constraints are indeed having impacts on firm production. So Josh mentioned already some examples. Ceres has done some good work collecting examples. Starbucks, Campbell's Soup, NTPC in India, Anglo American, all of these companies in recent years have disclosed to shareholders how water is impacting their business. So the second step would be to engage management. So the advantage here is that investors can not only verify location of operations, they can also get precise information and the finer points about how management is tackling the water problem. And we have an indicator here, water management programs that we cover for our full research universe. You can again see, it's quite surprising that in these water-intensive industries, it's very much a minority of companies that have actually implemented what we consider to be a sophisticated water management program. Some of the things that we'd be looking for show up on the left-hand side of the slide. So this is effectively best practice right now in corporate water management, things like efficiency programs, targets, the extent to which the board is responsible for overseeing management's approach on this issue. So again, this would be a way that investors can get a greater insight into the extent to which they might be exposed through their portfolio holdings to water risk. I can address that afterwards. So now in terms of the upside opportunities, this is the third pillar in our framework. We essentially put this in because in addition to thinking about how water can impact companies' production and the potential returns of portfolios, we also think it's the case that investors can explore certain upside themes. We think there are certain sectors of the economy that are indeed going to benefit as the water scarcity problem worsens. We've identified three broad buckets here. You can see on the chart they fall under the theme column, and we've identified some candidate companies that investors can consider for playing the opportunity. So desalination, of course, this is a bit of a controversial one. As Kate mentioned, it's obviously very energy intensive. It also happens, there's two main methods for desalination, and both leave a lot of brine, which presents a waste problem. But nevertheless, we are bullish about the desalination market as a whole, simply because we expect that a lot of countries will have no other choice once conservation measures have been exhausted. So we do think the industry is poised for growth. The industry has been growing in terms of the number of plants, desalination plants in the economy. The number has been growing at a 10% CAGR for the last 20 years, and it's forecasted to continue to grow at a 10% CAGR out to 2020. And I think on the cost side, it's true, as Kate mentioned, it is expensive. There's no getting around that. That's primarily because of the amount of energy that is required to thrust water through the membranes. But I would just flag that costs are dropping. So costs have fallen by 50% over the last 30 years as a result of improvements in membrane technology. So you can see here some of the companies that we like in this space include Acciona. This is a utility based in Spain. They already manage about 35 desalination plants globally, primarily in reverse osmosis technologies. Veolia in France, obviously a big name. They operate about 1,700 desal plants right now in over 80 countries. And GE, I mean, of course, GE is very much the antithesis of a pure play. I don't have the numbers, but I suspect water accounts for a fraction of their total revenue. But their water segment, GE Water is the name. We do think it is poised for considerable growth, and GE management itself has positioned itself to tackle and to capitalize on the surge in desal going forward. So the second theme is recycling wastewater. Essentially, what this means is taking it's a downstream supply solution. So it's essentially involves treating wastewater to remove solids and impurities, and then this reclaimed water can be used for irrigation. That's probably the primary application, but also for industrial uses and even for drinking. So the main advantage here is it's cost effective. It's much cheaper, much more efficient than desalination. The research we found shows cost between 26 cents up to 46 cents per cubic meter. The companies, unsurprisingly, that are best positioned in this space tend to be water utilities. So you can see here Suez Environnement in France. Right now they operate over 2,000 wastewater treatment sites. American Waterworks, it's a much smaller player. It manages about 81 plants, but it's got a big upside in the growth markets of the US and Canada. and of course Severn Trent, that's a well-known player in the UK. So it's true utilities tend to have relatively constrained operational footprints, but what we foresee happening is that a lot of corporates and indeed governments will, we foresee them approaching water utilities in joint ventures and things like that, and seeking out their core competency in these technologies. So the third way that investors, in our view, can play, or at least consider as an upside theme, is simply infrastructure plays. So the main problem here is that there's the aging infrastructure problem in developed markets, and there's a massive amount of water infrastructure that will need to be spent in greenfield projects in emerging markets over the next 20 years. The research we uncovered suggests a figure of up to $25 trillion in water infrastructure spending will need to be spent globally over the next 20 years. So clearly this is going to benefit companies that produce things like water pipelines, smart meters, pumps, valves, any type of analytical equipment. So all these companies are, from a fundamentals point of view, I think are poised to benefit. So companies that we like in this space include Geberit. They're based in Switzerland. They mostly produce faucets and flushing systems. Sulzer is obviously a really well-known pump equipment supplier. And then there's Xylem, based in the US, which is more of a diversified play. It produces everything from pumps, valves, and filtration devices to analytical equipment. So with that, we can conclude simply by reiterating some of the main points. We do think, like others, that water is destined to become a major investment theme as well as a major ESG issue this century. I think the solutions, anyone can agree, they're extraordinarily complex. They're going to require corporates, policymakers, regulators to have a seat at the table. I think investors can do two things. They need to assess their exposure to downside risks by taking a look at their portfolio companies and also by engaging with management. They also need to be thinking about upside opportunities, in particular around the themes of desalination, wastewater recycling, and water infrastructure. So that concludes the content portion of the presentation, and now I'll hand back to Hendrik.
Yeah, many thanks to Doug and also to Josh and Kate for running us through this challenging field of water-related investment risks and opportunities. So while my colleagues were presenting, we received a couple of questions from participants covering a broad range of issues and perspectives. We have another 15 minutes left, so let me, without further ado, start with the first question, which we received from a North American asset manager representative. So the question goes to Doug, and it's about the investment side of things. So Doug, are you really convinced that water will be a major investment theme in the years ahead? In other words, is there evidence that investors are already taking a closer look?
I am convinced it's going to be a major investment driver, a major investment theme in this century. However, I readily admit there's not a lot of good evidence out there that I've come across anyway to show any type of baseline trend or anything like that. I think anecdotally there's evidence that more and more investors are looking at some of these themes that we mentioned as well as others. And I do fundamentally think, though, that the water pricing issue is not going away, and this will continue to stand as a barrier to investment. But yeah, absolutely. I think the problem is immense. I think it's underestimated. I think a lot of investors may be undervaluing opportunities in this sector due to that reason.
Okay, thank you. So as a follow-up, what do you think about the data quality side of things? I mean, as you have shown to the audience, we looked at water intensity, and you mentioned the local aspects. So what needs to be done in order to improve the data quality? So the fundamentals of making an investment analysis based on water.
In my personal opinion, it's a major problem, both from a quantity perspective and a quality perspective. I think things are getting better, but first on the quantity side, so we know that right now only about 1,100 publicly listed corporations are disclosing their absolute water consumption, so total water withdrawal. This is about, it's about a quarter of the world's mid-caps or larger, so companies with 2 billion in market cap or more, and it's a fraction of all publicly listed corporations, obviously. So I think there's a quantity problem. I think on the quality side, I think anyone in the responsible investment industry could acknowledge that where we are today with water is significantly trails where we are with energy and carbon. So I do think on the quality side, I do foresee some big gains being made over the next couple of years. What will help drive that? I mean, I think it's the same drivers that will help improve greenhouse gas emissions reporting, reporting around other sustainability metrics. I think institutional investors can help push the dial forward by making their voices heard. But I also think at the end of the day, we're going to need regulators to step in and provide a much clearer signal from that side.
Yes, I couldn't agree more. And we now move on, and the next question goes to Kate. So Kate, the discussion about mining was interesting. A participant is saying clearly water is a major operational risk. So is it possible in this day and age that mining company could really be unaware of water risks, especially in water scarce countries like Chile? Are companies across the board improving their water management practices?
Thanks, Hendrik, for the question. So I don't think it's possible for any company to be unaware, and based on my research, most companies are now citing it as a material risk. I think there is, however, a lag between awareness of the issue and actual management systems. As Doug showed earlier in the slides, very few precious metals companies, for example, have strong water management programs that include things like reduction targets or recycling reduction targets with deadlines. And so I think there's a lag between the awareness and the actual management system change. A lot of companies, I think, are taking the time to do it right, and so they're doing really complex water risk mapping exercises and water footprint mapping exercises. For instance, Anglo American is undertaking that right now and going to roll out their water strategy in 2017, which is great, but I think the risks are much more pressing. So for some companies, especially depending on geography, it's going to be a race against time and the physical impacts of climate change. And for some companies, it's coming faster than they can work. Another way that water risk is showing up is also companies who rely on hydropower in certain jurisdictions are seeing energy prices skyrocket, which is also forcing them to cut back on production and in some cases generate power on site. And so that's another way that I would say the risks are sort of outpacing a company development. But I do think it's on companies' radars, and investors can definitely be pushing things along.
All right, so that is a kind of positive stance you're giving us overall. So the next question I received goes to Josh. So Josh, can you talk a little bit more about how water can push up procurement costs for food companies? Would food companies not be able to hedge against an increase in commodity costs by using derivatives?
Yeah, sure. So I think one of the main mechanisms through which procurement costs for food companies can go up is again, large-scale events that impact, that cause water scarcity, like an extreme drought, for example, that would severely restrict the production of a certain agricultural commodity, and as a result, increased global commodity prices, so making contracts for those commodities more expensive. And of course, companies can and will try to manage their exposure to price fluctuations by using derivatives, but ultimately, if this type of fluctuation becomes more frequent and more volatile, it becomes harder and harder to use that tool to manage the costs.
Okay, have you, as a follow-up, have you thought about scenarios, price scenarios, and their implications on food prices? So some kind of
sure. I mean, there's
global estimate. Yeah.
Yeah, there's some good examples in the recent past of water scarcity and weather events that cause water scarcity, increasing food prices, including record high soybean prices following droughts in the United States in recent years. At the moment, there's droughts going on in Vietnam, which is a large producer of Robusta coffee beans, and some are predicting that production in Vietnam, which is the largest producer of Robusta beans, could contract 30% in the coming year, which is significant.
Okay, I think there's more to come. Looking at the other questions I received, I would like to direct one to Doug. So Doug, looking ahead, what do you think are some of the barriers that might prevent investors from taking a more sophisticated approach to water risks?
The barriers, I think it's what we touched on earlier. I think from a portfolio standpoint, one of the biggest barriers is the lack of disclosure. I think that's a more significant barrier than the lack of analytical frameworks. You know, in the course of doing research for the paper, I encountered, lots of papers arguing that it's not just disclosure. Investors also struggle making sense of this information and developing analytical frameworks. I'm not convinced of that. First of all, I don't think it's rocket science to build the analytical framework. I think the most significant barrier is the raw material. So we need more listed companies, especially the big ones, to take more steps to measure and publicly disclose their water consumption. So I think that's the most significant barrier.
Okay, coming to the investment community, Doug, do you see that or foresee that investors will take a more active role here in terms, for example, of water footprinting, so similar to what we see in the carbon field? Is that something that you think is realistic to expect over the next couple of years?
Yeah. I think that phrase, active, water footprinting. I think we have to understand, precisely what that means. But I think, yeah, I can definitely. I mean, some are likely already doing that, and they are already doing that. I think one of the struggles, though, is for some companies, even for large, sophisticated institutional investors, so the biggest investors on the planet, it might be hard even for them to get a very precise understanding about the specific location of a company's production facilities. And certainly for smaller investors, it's very, very hard. So I think it goes back to the idea of locality, just how important it is to have a sense of the local exposure, where these assets are located, etc. So I think to do a really meaningful footprinting exercise, you would really need that information.
Okay, so maybe another question to you, Doug, but also to Kate. As we all know, we have this big carbon bubble discussion and the topic of stranded assets related to increasing CO2 prices. So do you think, or how large is the risk that we talk about a stranded assets issue related to water risks in the years ahead. We talked about introduction of pricing mechanisms. Is that something investors need to worry about?
That's really interesting. I've never thought about the idea of the water bubble. Maybe we can explore that in the future. I don't envision it taking on the same shape as the carbon bubble because carbon is actively being priced. We're not very good at it. I would argue we're getting better, but regulators have definitely explored that, most prominently in the EU. But by contrast, the water pricing is nascent. It exists only in a handful of countries. And as I mentioned earlier, it's even though I think my opinion is that we will be exploring these mechanisms more and more. The truth is there's tremendous public resistance to putting a price on water. Water is an input, unlike carbon, which is an output. We also have to think about that. So it's possible. I mean, I guess in the mining sector, I'm not the subject matter expert, but I can imagine, water restrictions could very well curtail the production at some assets and make them stranded.
Yeah, and just to add, with low commodity prices and increasing costs also on the energy side, I think water is certainly not the only factor causing companies to either curb production or shelve or mothball certain projects, but it's a strong contributing factor to some companies' decisions to pause development.
All right, so it's close to 5 p.m. European time and 11 a.m. Standard Time. So we are approaching the end of the webinar, unfortunately, so I think it has been, or our speakers have delivered very interesting insights, and I hope the audience considers this equally to be the case. So thank you to Doug again, thank you to Kate and Josh, and of course also a big thank you to the audience for being interested in the topic and in our research and asking these valuable questions. We hope that you all gained indeed fresh insights into the topic as provided by our speakers. So once again, thank you to the speakers for sharing their views with us. And with this, I'm closing the session for today. So goodbye for now, and we hope to see you soon again in one of our forthcoming webinars. Thank you.